Good afternoon, traders. Welcome to FreeFX, and today is Sunday, the 6th of March. It's a particularly important time of the trading year because we are getting close to a number of events in the third month of the trading year. And for that reason, I decided to dedicate my video today on a particular topic. First of all, let me show you the disclaimer. And the topic today is something that has been indeed on the go since 2013. And this particular theme is related not just to Great Britain and British pound, but to a number of issues affecting the wider context, particularly Europe. So the topic of the day is indeed Brexit. Now, I put a question mark on there because I believe that it's very much, it hangs in the balance of what will come in the referendum, which will be the 23rd of June. This means that there are a number of scenarios that we have to explore, and for that reason alone, I'd like to concentrate on a simple chart, as you can see here, really starting the conversation from here and maybe taking it out wider as we go. My first concern as somebody who lives in the UK is really to do with how we actually engage with this topic. Because on the one hand, there's the emotional side that indeed is very much part of the conversation in some corners, and we've had, if you live in the UK, you'll know that the conversation has been very politically charged, especially as different sides of the ruling party, the Conservative Party, have different opinions on this. So indeed, it's not the first referendum on Europe. There was one in the 1970s, and the argument running that precisely because it's been a long time, there should be one now. Now, in terms of the other side is the more rational side, which is really what we should, in a way, try to see when we are approaching this from a trading perspective. As a retail trader, I am mostly really of a view that I shouldn't be emotionally attached to the pound just because I live in the UK. But conversely, I shouldn't be detached from Europe because there are implications as a trader, really, in terms of the European single currency. One aspect of this is that if you were trading something like the pound dollar, you may think that there isn't really anything to do with Europe at this particular point. And you may be justified in saying that, but if you were indeed trading something like a currency pair, which I have been trading, the euro pound. Now this will give us a different view because obviously it is pitching the British pound with the single currency, and we have here a different backdrop, and also it complicates things in a way because taking the view that Britain leaving the European Union would be good for Britain, in a way discounts the view that Europe would be good without would be unaffected by Great Britain leaving. But in fact, we have seen in the last few weeks how the euro has been affected by talks about Europe leaving Britain behind, or vice versa. And we have seen that in a number of assets. We can see here's the euro pound since the end of 2015 has been climbing aggressively, but as the Brexit talks started, we have seen a stall in this rally, and it never really quite fulfilled its potential, breaking the 0.80. But let's not focus too much on levels at the moment, because I want to go back to the topic in hand, which is the issues of fundamental analysis in this case. But again, if you look at the Euro USD, just to complete, there has been a drop here. And this again suggests that it isn't all euro driven, it's pound driven in a way. And this really tells us a little story. And so the pound in January has been dropping aggressively, and February is also down, and this is where we are now in March. Okay, now let's look at the chart with a view that we are trying to see, look into probabilities. We can't read the future, nobody can, but we're looking into probabilities, and we really want to see what we can make of the British pound going forward. And this chart goes all the way back to 1993. Okay, so we can see that we were roughly in the 1.50 region, and down here we were in a 1.40 region, 40 to 45. Down here we were around the 40 to 45 again, or 50. And at the moment we're below that. We are sort of at the bottom, very bottom, sort of 140s, but still within that range, 140 to 45. Okay, so you see that here we have very long wicks, but really we stopped at 1.43 roughly. This time is solid bodies below, and so we have closed around or just below 140. So the previous month was indeed an historic low, and we are in a way repeating a cycle that stretches all the way back to 1993. So when looking at a chart like this, we must be aware that however seemingly groundbreaking the news could be on the referendum on Britain, we can indeed look back on, if we went back to September of last year, and you'll see that okay. So September of last year we had the Scottish referendum vote. You will remember that the referendum was also very was highly anticipated, and that in a way we had a lot of talk about whether Scotland would become detached from the United Kingdom but stay part of the European economic area, or the European Union rather. And so when the vote came on the 18th of September, okay, there was the 18th of September, and there was the weekend gap, and so this is the pound, and indeed you will remember that. I'm sorry, I just realized that we have given you the wrong year here. It's 2014. I was slightly running ahead of myself there, hadn't realized it. I hadn't scanned all the way back to 2014. Okay, let's start again. So so our conversation here is relating to the Scottish referendum. And what is important is that really the political establishment, in a way, doesn't sometimes, as a whole, not particularly individual parties, or cannot in a way escape momentum and history, and in a way cannot escape repeating its own mistake, which is to feed the media machine and become an enemy of itself. And I think for that reason we must we must be sure that this isn't a repeat of that. What I mean by that is that there should be some kind of skepticism when we hear politics declaring themselves to be proposing something that has never been proposed before, and that this will be a completely different scenario, Equally, we must sort of be aware that catastrophic scenarios that are being portrayed will not, in a way, always come to fruition. In other words, we cannot say that the theme of Brexit, like the Scottish referendum, or Scot exit, or Scoxit, if you like, we cannot really say truly that one outcome or the other would be disastrous, because we don't actually know that for sure. So it's not enough to say that uh, the best minds have pronounced themselves in one way or the other, because truly nobody knows the effects of staying in Europe, and also the fact that political uncertainty, once the die is cast, that sense of uncertainty doesn't go away, even if a vote on a particular topic goes the way that people in power perhaps wished it went. And that's not a vote of confidence necessarily in that particular system. So you can see here that there was a gap down over the weekend when the referendum was announced, and then there was the vote on the 18th of September, if I remember right. And then you can see that the fact that the United Kingdom remained united didn't really bring much for the pound. So if we just minimize that a little bit, squeeze it in. Now you see that there was a trend starting here from the 172, okay, in July of 2014. When the referendum was announced, it was already down to 1.63, so it lost nearly 1,000 pips, nearly. And then it gapped down, and then the sort of good news story didn't really do much for it, and it continued to drop all the way down to this April of 2015, down to sort of 145s. So what I'm trying to say is that let's sort of make some just very general areas here. Okay. So this area here is the area of, in case you join this video a little bit later, I'm going to write some things so that if you skip forward, you'll see them again. So Scottish referendum, we'll make it quite obvious, so slightly bigger. Okay. And then make that also quite wide. Okay, so we have, essentially we have, the lowest point in 2015 was about 1.45, and the Scottish referendum here was, yeah, so we're about the 162, 163, okay. So from the Scottish referendum to this point, okay, a further 2,000 pips occurred. And then from this point to the lowest point, which is this year, February, we had basically nearly a year. So the entirety of 2015 was spent crawling back up to this level, 1.59, so under 160, which essentially is where we stopped around the Scottish referendum time. Okay, and then it sort of plummeted back, and we're down here now. What I'm trying to say is, had the Scottish referendum gone a different way, so Britain had left, what more could have happened that didn't happen naturally? What I'm trying to say is, if we were destined to see a pound devaluation, well, here it is. It occurred naturally. So if I made this a weekly, or a monthly actually, you see that, okay, the devaluation that was occurring in the month of the referendum, 1, 2, 3, 4 months, 5, 6 months in, we saw the lowest point in a very long time. Okay, in fact the lowest point since here 2009 in sort of more recent history. So 6 years. Now I'm trying to say that basically this is irrelevant. It's irrelevant because there was sentiment already in motion here preceding the Scottish referendum, but I think what this came on the back of the failed British pound bid, because we had Carney came to power on the Bank of England in July 2013. Here it is, okay. And then the pound started rallying from this 150 to nearly 172, around 172. Okay. And then, you know, the cycle of backing the British pound and the bid for a Bank of England appreciation of its interest rate failed. And that's when we started seeing this. The weight of the Scottish referendum from this and this alone shows that it wasn't particularly relevant. But one must remember that at the time, the weight of public discussion and of media frenzy made it seem like the pound was falling and the world was coming to an end in the UK because of the Scottish referendum. And those terrible people who'd engineer this sabotage of the United Kingdom were to be blamed. But in fact, as we can see, it's nothing of the sort. Another thing to kind of show this is that it's always worth comparing different asset classes, because when you look at the equities market, so the FTSE 100 as a thermometer, as a gauge of sentiment for the UK, you can see that indeed we have the September of 2014 was a down month, but in truth we'd already roofed around May of that year. So the rise here had been capped much before, and this high 2007 had held, okay, 6 years later. And so we cannot really say that it was the Scottish referendum that was to blame when this drop occurred. And then the next month there was a massive drop, and then it recovered, but it never truly recovered, because then we've had down months now for the late 2015 and the first 2 months of 2016. True, these long wicks tell a story that prices sort of held above 5,500, but it has held, but these are nonetheless lower lows and these are lower highs. So we're yet to see a bid for FTSE 100, or for that reason a bid for the pound. And there is a correlation between equities and the pound. Therefore, one must be aware that it isn't enough to say that the pound is an island. There are other forces at play, and we're looking for correlations with other asset classes. So I just wanted to make this very small point that the discussion on Brexit is not really one that should dictate trading decisions, at least for the longer term, because the longer term scenario here, if you look at 7-year cycles, we have essentially from 95 to 2002 to 2009 and basically to 2016. We have these 7-year cycles, and basically where we're at today is the same height, if you like, as we were in sort of 90s. I'm trying to kind of show you that it is almost a symmetrical shape. This is not to say that there'll be a repeat of what happened in 2002 with this massive rise. What I'm trying to say is that we are looking at cycles. Okay, the shape of this cycle is not the same shape as of this cycle in terms of magnitude, but certainly it's a fair rise from this sort of 140 level to the 170 level, and this happened not once but twice because it happened here as well. So the next level, because we've reached the bottom here, really truly the only way is up, because there is no reason why the pound should fall further. It could fall a little bit, but there are reasons unknown to us why it has never fallen below 140. By fallen, I mean not pierced through. See, down here is 1.37, and down here in 2009 it reached down to 1.35. So we haven't actually got to 135, so it could fall another 300 pips roughly. We're at 139 at the bottom of this candle for the monthly of March. But you know, even another 300-400 pips in the greater scheme of things isn't actually a big deal. My point of view here is not the intraday, the trading done, you know, on a day-by-day basis, where we might sort of hope to capture, you know, 10, 20 pips, or some people might like to capture 100 pips, depending on the pound pairs. Some people like the pound kiwi. Would move 200 pips easy on a single day, if not more. What I'm trying to look at here is stating a longer term view, because really anybody who's trading along a trend, so if you're trading shorts along this trend, okay, from July 2014, you know, if you'd held a short from July 2014 and you know, gone through the pain of seeing your short interest diminish and then regaining traction again in 2015 to 2016. If you've done that, great. But even if you're trading short term, you might like to know at least what the general trend is, so that you're trading in the direction of the trend. And what I'm trying to say is, look at the shape of these and you'll see that we are at the bottom. And history doesn't repeat itself, so it's not really worth going into a lot of detail. But certainly, if you were to make a little analysis here of what happened, you'd have to go into the fundamentals of what happened between 2001, 2002. One thing's for sure, that in 2001 the euro was released. Whether this is to do with the euro, you'd have to go and look for yourselves and really see whether it was the increased trading potential that the United Kingdom had with its neighbor that in a way increased, or whether it was to do with the government of the time, or whether it was to do with you know, the boost in Britain's exports. Or there are a number of things that you know, we can go into and study and analyze past history. It's not enough to look at a chart. I don't have full knowledge of everything that happened in British financial history, so forgive me for not giving you more at this point. But certainly, looking at this particular area, what we find is that once we got down into this 150 to 140 area, so 1,000 pips, we pretty much stayed there for a number of months. So that's from August of 2000 to basically we got out of it in July of 2002. So nearly 2 trading years. Okay. So when we look at something similar like this, okay, So we got into the 150 and stayed above it, and we penetrated that 150 in December 2015. So we might spend a period of time in this area 140 to 150, and so if you extended it by that much, okay, then that would be roughly similar time period as sort of 2 3/4 of these squares, so 2 and yeah, roughly that time. So that would take us to about the end of 2017. And indeed, there have been talks among analysts and business media that the Bank of England is not expected by market commentators or economists to be raising rates um, before 2017 now, if not later. So that certainly means that if the Bank of England does nothing, then there's nothing really playing for the pound, and we could be mired in this sort of area for until 2017, so for a number of months. The alternative view is that markets function technically, so there is sentiment, but there's also price. And indeed, if we had um, um, the assets denominated in pounds, if we had assets that banks could purchase, or large investment bodies could invest in. In other words, if something denominated in pounds is attractive to enough people with enough capital to push the pound itself higher, this will happen, and it will not be because of a renewed Bank of England bid for a rate rise. It won't be because of the Brexit fears. It won't be because alleviated in June. It won't be because of any of that. It will be because perhaps, regardless of the Brexit scenario, perhaps the pound now is quite cheap. And if the pound is cheap compared to the US dollar, perhaps financial assets are cheaper too. And so one could buy in the hope of buying it cheap, and by doing so, whether to buy or hold, but certainly to push the price of the pound higher, that would be second nature. I don't know if this has been helpful in any way. Certainly looking at other pound pairs, we can see that the euro is struggling against the pound, and that's because we've seen that slight rise in the pound against the dollar. This comes into a wider trend, which in a way has not diminished, and the top of this would be somewhere in the region of 80, 82. So depending on how you draw it, but essentially we are near that top of this channel. Now, when you stretch channel lines along so many years, it does become difficult. But certainly as a price, you can see that back here in 2008, before the euro shot up during the financial crisis, we were struggling for months and months and months and to go past 80. And indeed, we didn't go past it back here in 2014, and so that went on for almost the entire year. And then we have indeed seen that this year is no different. We basically it struggled up when perhaps euro shorts were dumped across euro assets, and then fair enough, it got up to here, but it doesn't look like it's going to have any reason to go up, because who wants to buy euros? Yes, the euro is cheap, but it's not that cheap. Look at the euro USD, it's cheap, but it's not that cheap. It has been cheaper. Okay, so look back in 2000s, before the introduction of the single currency, we were down at what would now be 0.85 pre euro. When a euro was introduced, hela, here we go, up it went. So there is scope for it to fall further, and indeed we never got to parity. There's been a lot of talk in 2015 about the euro falling to parity. It never did, but it could. It could really go down to parity. So the euro could fall further against the pound as well. But the pound falling further, don't see that happening because for a number of reasons. There's no interest to make it fall further. There's no gain. So the pound is going to go up. How much? Well, we'll have to see. Certainly, it's not like some people might say, well, is this a trade of a lifetime? I don't think it is now, but it might be if you have time on your side. You're not about to rush into a trade for quick gains. If you have patience, this could develop over weeks, months, even years. So yes, it's a good time to buy, but it might fall a bit further to 135, then slowly regain. But how long it will take to get out of this range that we've seen before, 140 to 150, nobody knows. So that's basically the bottom line, is that nobody knows in markets how long things take to develop. Certainly, as we saw this, once a trend of this magnitude starts, and you must be prepared to uh, um, basically sit through big drawdowns. But the rewards over time, and I stress that over time, months and years, from 2001 here to 2007 here, we're looking at 4 years. Basically, this is well worth the wait. How long you want to capture, how long you want to stay in a trend like this at big corrections, moments like in 2005, 2006, where it corrected quite considerably. That is entirely up to your risk management strategy and goals, but really it is worth pointing out that for the number of trades it takes to construct something of this magnitude, on a day-to-day basis, you're more likely to get uh, blown out of your account if you're trying to replicate this magnitude in a small number of trades, over a number of days rather than weeks. You'd have to take incredible risks, because really going from 140 to 2.10, okay, that's 6,000 pips. That's 7,000 pips. You can't possibly think that you can replicate 7,000 pips in a week, or 7,000 pips in a month consistently. So you have to be prepared to hold something over a long period of time and trade conservatively with smaller lot sizes, maybe nano lots. So having said all this, the only thing I can say is that next week we have the ECB rate decision and the RBNZ rate decisions. These will impact obviously pairs like the Euro Pound, and also pairs like one of my favorite pairs, the Pound Kiwi, which has been mired in difficulties. If you were trading to the short side, you might say that certainly there's been no difficulty from getting from the September 2015 high to these lows. It's been a pretty straightforward ride. But if you were a bull from April of 2015, and you were expecting this to continue from this small correction October 2015, and it didn't, well, it is going to trouble you. So bulls might see this large downtrend and a sort of inverse head and shoulders, with the head here and the shoulders here, and this being the breakout or reversal over this massive multi-year downtrend. And like any reversal of a large trend, it takes time to build. So we might be coming down to the neckline, or the top here where the shoulders are, and then continue higher. Nothing happens in a straight line. This sort of skyrocket move was incredible, and will profited from that, but certainly what happened afterwards was a complete collapse of that move, almost retracing. We traced 3/4 of it, so almost the entire move. So the rate decision from the Reserve Bank of New Zealand on Wednesday will give us a bit of movement in its pair, possibly. If it's overdone to the downside, it will certainly pick up with some pace, regardless of the pound zone potential, because this pair is moved by the Kiwi dollar exchange rate, and if the Kiwis whacked on a rate cut from Governor Wheeler, this pair will just burst. It will literally flare up, at least on an intraday basis. Whether it will continue or not depends on a number of things, but there'll be a strong reaction. There is a lot of interest on this pair. There's potential because it's away from the risk theme in some ways, although in other ways it's responded in this aggressive move down on risk aversion themes late 2015, early 2016. But we must certainly look at the rate decision from the RBNZ as a catalyst. So I will leave you with thinking about the pound generally over these different pairs, and keeping an eye on the FTSE 100 as well, because there is a correlation between the two pairs. So we must certainly keep an eye out for the two, and make sure that we appreciate when this correlation happens. As you can see here, the down move in the FTSE 100 from middle of 2015 to now has been accompanied also by the pound down move. The two have basically been in correlation, positive correlation. So it's worth kind of thinking about when they diverge, when they converge. At the moment, they're converging. So if the FTSE 100 continues to drop, but the pound is starting to rise and they're moving opposite directions, then potentially, if the move is strong enough in opposing directions, the further the FTSE 100 is seen to be falling, then you might expect that the pound also picks up if this negative correlation makes a switch. So, all right, thank you very much for listening, and I'll see you in my next trading video sometime soon. Subscribe and leave comments. Thank you very much.